Good evening, friends, and welcome to K Ratings webinar. The topic today is Road Sector Perspective, Challenges, and Way Forward. I'm Amod, Khanorkar, Senior Director and Head of Infrastructure Activities and moderator for the today's session. We have today with us some of the best minds in the industry to discuss some of the issues pertaining to road sector and place their perspective before us. I would like to introduce you to our esteemed panelists. I'll go in alphabetical order. Mr. Ajay Mahajan is my MD and CEO for Care Ratings. Ajay has over 3 decades of experience in the BFSI sector. He started his career with Bank of America, where he went on to become the MD and a country head of the Global Markets Group. Ajay has worked in various entrepreneurial and transformative assignments during his stint at UBS, IDFC, and Yes Bank. Later, he started his own venture as managing partner and co-founder of Ask Advisors. That's an investment management and market risk advisory firm. Ajay graduated in engineering from BITS Pilani. He is also a gold medalist in MBA from Faculty of Management Studies at Delhi and a holder of a CFA from a CFA Institute, USA. Welcome, Ajay.
Thank you.
Our next panelist is Mr. J. Subramanian. Mr. Subramanian is currently the CEO of L&T IDPL Indinfravit Services, the investment manager of. Prior to this, he worked as at L&T IDPL, holding the dual position of Chief Internal Auditor and Compliance Officer. Before joining L&T IDPL, he worked as a general manager in the key infrastructure group of Airport Authority of India. So that's quite a variety of experience that we have here. He has more than 10 years of experience in policy formulation in the airport sector, including in developing and implementing PPP models. Mr. Subramanian holds a degree in commerce and is a member of Institute of Cost and Management Accountants. Welcome, Mr. Subramanian.
Thank you.
Our next panelist is Mr. Radheshyam Mopalwar. Mr. Mopalwar is an IAS officer and he is a vice chairman and MD of MSRDC since 2015. Prior to this, he was divisional commissioner at Konkan in Maharashtra. He was also member secretary of Maharashtra Jeevan Pradhikaran as well as Maharashtra Pollution Control Board. Mr. Mopalwar brings with him vast experience of working closely with various state-level regulatory bodies since 1993. As I said, he's an IAS officer, holds a bachelor's degree in arts and law. Again, a very warm welcome to Mr. Mopalwar.
Thank you.
I now introduce you our next panelist and a good friend, Mr. Shiva Rajaraman. Shiva has a 23 years experience in infrastructure finance and advisory. He is a CEO of L&T Infra Debt Fund, one of the India's leading infrastructure debt fund. Prior to this, he was employed with India's specialized infrastructure financier, IDFC, which is now an IDFC bank, and also along with the equity group of Dresner Glenward Benson. Shiva is a member of Infrastructure Committee of CII and FICCI. He is also director on the board of Feedback Infrastructure as well as Indian Highway Management Company Limited. That's a company belonging to NHAI. Welcome, Shiva. Our next and the fifth panelist is Mr. Vinod Agarwal. Mr. Vinod Agarwal is a managing director and one of the promoter of GR Infra Projects Limited. He has over 2 decades of experience in the road constructions industry. He looks after the strategy and policy formulation at GR and liaises with various departments of government and also overlooks various functions including bidding, tendering and planning at GR. He is also vice president of National Highway Builders Federation. Welcome, Mr. Agarwal. A very warm welcome to all the panelists and thank you for joining today. Now, a few preliminary remarks on today's theme. The Indian road sector is going through extremely challenging phase, as all of us know. with vast opportunities to scale up, requiring major investments to build or upgrade existing infrastructure. In a bid to monetize on these opportunities, the governing authorities and private participants have been working closely. Introduction of new variants of PPP model to facilitate road infrastructure growth are some of the many initiatives that have been taken in this direction by the government. Meanwhile, the toll-based road, which is a subject of discussion today, these projects continue to face the ire of lenders and investors. So also developers as well as the end users. The mismatch in cash flow for the former three, while mismatch in cost benefit expectation for the users, that has reduced the risk appetite for a toll road concessions. That the attractiveness in that sense has come down. Even the latest variant, HAM, has far from being a successful in terms of a infrastructure creation perspective. NHAI achieved 3,200 kilometer project award against targeted 4,500 in FY20. It has now set a target of 4,000 kilometers to be awarded in FY21. Now, will this be achieved? Is there enough bidding appetite for new projects? These are some of the questions, which I'd like the panelists to sort of debate on. Also, the ambitious national infrastructure pipeline announced in December 2019, it requires firing of all cylinders from all the quarters, be it regulators in introducing and implementing new reforms, lenders being less averse to lending to the road assets, or developers adhering to contractual terms and bringing in bidding discipline. Everything and each of this is crucial. So we have few more questions. Is regulator addressing enough on the issues? Are lenders turning overcautious? How can investors play an enabling role in path building story? To put things in perspective, CARE Ratings has a leadership position in rating of road projects in India amongst all rating agencies. So it's pertinent that we try to distill this portfolio, distill our understanding, and try to bring it for benefit of the investors, and thereby we analyze our portfolio in terms of performance and the challenges that we see, the outlook that we hold. Now, all these we shall present through our presentation, which my colleague will be making today. That will be followed by the panel discussion. And after the panel discussion, we'll have a Q&A with the participants, where participants can ask their question by raising hand or just typing in the question in the slot provided. I'll request participants to indicate if they are directing the question to any particular panelist. But before that, I would request my MD, Mr. Ajay Mahajan, to provide his opening remarks. Over to you, Ajay, please. Thank you.
Thank you, Amod. Thank you for the introductions. Welcome to the panelists. As I kick this off, good evening, friends, and warm welcome to today's webinar. Let's take a my quick take on today's topic and its relevance. To be honest with you, we have such stalwart experts on the panel that I will only try and make some high-level comments on infrastructure sector in general and broadly touch upon the road sector, and then wait to listen to our panelists who have substantial experience in the field, and nothing like hearing from the people that have real down to the wire experience in practical life. So let's focus on some high-level top-down numbers. According to the World Economic Forum, the global investment in infrastructure sector is expected to be $79 trillion by 2040. And the Oxford Economics apparently suggests that the estimated infrastructure requirements are as much as $97 trillion by 2040 globally. And undoubtedly, roads and electricity subsectors are actually the most important subsectors within this total requirement and constitute the chunk of investment needs here. Now, we are all aware that infrastructure building requires huge amount of capital, and private sector players have to be invited with lots of projects. So government needs to have a proper pipeline of projects from time to time. And we know, and I think Amod, you touched upon it in your opening remarks, that we are aware of the national infrastructure pipeline that was announced in December 2019, adding up to over 100 lakh crores. And the sector focus predominantly remains energy and roads, which constituted collectively about 43% of the total requirement. And also that the NIP envisages doubling of infrastructure spend from 5% of nominal GDP to 10% of nominal GDP over FY21 to 23. Now, however, NIP targets, to be honest with you, look a little ambitious and somewhat unachievable to us from where we stand today. Road sector capex outlay in FY20 to 25, 5 years, is expected to be 21.6 trillion rupees. Now that's 10% of GDP and 20% of the total planned investment outlay under NIP. The funding outlay is to be shared equally between the center and state at 40% each, and the balance 20% has to come from private participation, which are also very large numbers, 4 lakh crores, upwards of that. Now let's look at infrastructure from a financing standpoint. Infrastructure financing always required a long-term solution. We've been grappling with it for the last many years. In India, it's dominated by banks. Longer-term financial institutions are history. We all know that. Many of them have led their way into mergers or reverse mergers or conversions into banks. And banks, as we all know, had a much smaller liability profile, much shorter liability profile, and perhaps take a substantial amount of asset liability risk in financing infrastructure. That challenge has always been there. As a percentage of total credit outstanding, just the infrastructure sector would count over 12% of the total outstanding sort of bank credit. And power and road sectors have the largest exposure, about 72% of this outstanding of 12%. The regulation needs to really enable funds flow. The other challenge that we're seeing is that in hybrid annuity type of projects where returns are linked, or rather the reimbursements of annuity, unpaid annuities are linked to bank rate plus 300 basis points. The bank rate has already collapsed from numbers near 6% plus to 4.25% with the last rate cut of 40 basis points on Friday last. So now with 200 basis points approximately of bank rate reductions, this could upset any project cash flows and DSCR calculations on the project. So we need to look at whether the Credit Guarantee Enhancement Corporation and certain other measures that the government announced in the budget would actually aid funds availability for infrastructure sector. Increasing the investing universe happens to be another challenge. Bond markets in India don't necessarily grow aggressively to support project financing. We all know how some of the mutual funds have struggled in the credit funds to even sell AA minus paper at a difficult sort of time. And of course, we are discussing a COVID situation, which is clearly not a normal business situation. It's an unusual black swan event that businesses have been hurt with. But nevertheless, the bond markets in India have hardly given any significant sort of avenue for financing infrastructure sector, right? So there are a plethora of issues, and before I speak, I don't want to spend too much time, but I just want to highlight some of the issues that, honestly, as a follower of infrastructure sector, having worked in a bank and institution before this that specialized in infrastructure for many years, I would say delay in achieving financial closures of new projects as banks are risk averse to the sector is an issue. Delay in declaration of appointed date and largely due to right of way reasons is a big issue. There are tardy award of contracts in this sector. There are delays in approvals. There are delays in clearances. Land acquisition costs have gone 3x in 3-4 years, and that obviously is hurting right of way, and therefore allotment of projects and appointed dates are harder to issue even after the award dates by 1.5 years, and so on and so forth. The issues related to sanctity of contracts. I mentioned that there are underachievement in traffic projections. The hybrid annuity model, as mentioned by Amod in the opening speech, also is now beginning to be challenged, also because of bank rate issues, and also that the existing HAM projects have seen substantial delays. There are other issues, traffic leakage due to alternate roads. That's a big issue. I remember having seen that in many cases, which my previous institution had financed. Inefficiency of cash collections of tolls. FASTag is hopefully going to plug that, but with right now entire revenue under challenge, that's a different matter. But hopefully FASTag will increase 5 to 7%, maybe 8% collection through electronic forms of clearing. There are revisions of axle load norms that have also hurt the number of vehicles on the road. Exemptions to adjoining villages, that's a big challenge. I remember seeing some highway projects where the local villages are usually exempt, and the center-state coordination on such issues leaves much to be desired. And local villages also sometimes use just brute force to push their way through toll roads, and many times even end up damaging toll plazas, which is not a pretty sight and does not necessarily do well to attract foreign investment and longer-term private sector investment to these businesses. So there are multiple bottlenecks, as I've just pointed out, and there are lots of sector-specific issues which have acted as a dampener for all the stakeholders, and this is reflected in the form of reduced bidding as well as lending appetite. Now, so therefore, ironing these out would be extremely necessary for the achievement of the set targets, in my view, including collective attempt to reduce cash flow risks of the project. Ultimately, capital will come if there is a reduction in the cash flow risk of projects, and that is hurting all three: the government, the sponsor, and the lenders. Tightening PPP frameworks have to happen. Amod touched upon it. I would be very keen to hear the panelists' comment on this. Assigning clear roles and responsibilities and accountabilities upfront is very critical. Making the independent engineers appointed to assess the projects and assign COD, etc., in coordination with regulators, they have to be made more accountable. They can't let decisions just languish, going back and forth with regulators and not making decisions. In the process, wasting incredible amount of time, leading to cost escalations, IDC adding up, and projects becoming unviable over a period of time. Now, these are indeed challenging times, and I haven't touched upon COVID-19. But COVID-19 is a clear crisis, and the outbreak of this crisis, the implementation of the infrastructure pipeline, as we talked about, will government simply have the resources? We are talking of a 7% central GDP deficit, and we are talking of a 5% most likely state deficit this year. So with 12% deficit financing to go through, will the government simply have the resources to keep the infrastructure sector in good clip and to stick to the goals that the government aligned itself to in December 19? Will that happen? Will that not happen? Will we get a little off the road on this one? We look forward to listening to our experts. So on this note, I think I'm kind of done with my opening comments. I would request Amod to proceed with the webinar and have the panelists deliberate on these topical issues. And I'm sure the audience looks forward to gaining insights from our panelists. Thank you. Over to you, Amod.
Thank you, Ajay. That's a very succinct way of putting across the issues and key challenges. We shall now begin with KR's presentation on the road sector. I request my colleague Maulesh to commence the presentation. Maulesh is an associate director and also sector head for road projects at KR. Over to you, Maulesh.
Thank you very much, sir. In today's presentation on the road sector, we shall cover about the pace of award and execution, government of initiative during FY20, KR's presence in the road sector along with the rating dispersion, and KR's perspective on both operational toll road projects as well as the hybrid annuity mode projects in detail. So beginning our presentation with the industry update, after recording the highest ever award in FY18, project award has declined in FY19 and consecutively in FY20 also. So as discussed in the earlier phase, land acquisition issues, delays in achievement of financial closure, and in turn reduced bidding appetite are the prominent reason for the declining award. If we look at the pace of execution, so NHI's initiative to declare the appointed date only after availability of the 80% ROW has resulted into the consistent increase in the pace of execution, with record around 4,000 kilometers of construction reported in FY20. However, the same is expected to be declined from FY21, mainly due to declining awarding activity in FY19 and FY20. If we look at the awarding pattern, PPT investment through HAM mode has started losing its shine, with EPC projects gaining a lion's share. This is expected to continue till there is an improvement in the fundraising bidding, till the improvement in the bidding appetite and funding avenues. However, Government of India has taken various initiatives over last 1 year. If we quickly look at that, so first initiative is NHI's plan to settle the arbitration claim through conciliation committee in place of opting for the lengthy judicial processes. NHAI plans to release the arbitration claims of around 32,000 crore through conciliation committee. NHAI has also started extending interest-bearing working capital advances in lieu of construction grant upon achievement of intermediate milestone, which is expected to increase the pace of execution for HAM projects, especially when there is a delay in the term debt disbursement. Fast track is expected to curb the toll leakage and tweaking the TOT concession to improve the credit appetite. Now let's glance at a CARE's presence in the road sector. CARE Ratings has rated 186 companies with a debt of around 75,000 crore. CARE Ratings enjoys nearly 50% market share across all CRA in terms of ratings of road projects. If we look at the rating dispersion of CARE's portfolio, so around 60% of the portfolio is in the investment grade. Nearly 23% of the portfolio is in the sub-investment grade, while 17% portfolio is a CE rating when the rating derives credit enhancement from the guarantor's rating. So if you look at the AAA and AA category rating, which comprise of annuity projects of NHAI, toll projects with healthy track record of toll collection, and some of the InvIT structure. If we look at the A band rating, so it comprises of mature toll road projects, under construction HAM projects owned by strong sponsor, and state annuity projects which are operational. If we look at the sub-investment grade rating, so we can say that delay in the execution, significant underachievement in the toll collection, and weakening of the sponsor profile in the annuity projects are the prominent reason for the sub-investment grade ratings. Now we shall share our perspective on operational toll road projects. As inferred from the slide, toll collection has declined significantly in 9-month FY20, mainly due to change in Excel norm, which has a dual impact. First, reduction in the overloading income, and second, reduction in the freight vehicle flying over the road. CARE Ratings expect decline in toll collection by 2.5% during FY20, mainly on account of dismal 9-month FY20 performance accentuated by toll suspension due to COVID-19 outbreak. Outlook for CARE Ratings for toll project is negative for FY20 with expectation of deflation in toll collection by 21%. Sustained intensity of COVID-19, global economic slowdown, and expected delay in the ramp up of construction as well as mining activity are the prominent reason for such belief. Considering financial fallout, Reserve Bank of India has taken a timely action and extended the moratorium on the term loans till May 2020, now which is further extended to August 2020. Majority of the 86 operational toll road projects rated by CARE have availed this moratorium benefit. Debt Service Reserve Account, DSRA, is the prominent and carries a paramount importance in the operational toll road projects for managing the short-term disruption, especially in the COVID-19. In this backdrop, CARE Ratings has analyzed the availability of the DSRA in its portfolio of 86 operational toll road projects with aggregate debt of 35,000 crore. As inferred from the slide, 21% of the projects are rated in the BBB category and 26% of the projects are rated in A category and above. Hence, 47% of the projects are rated in the investment grade category. Out of these investment grade category projects, 78% of the toll road projects have availability of the DSRA, which provides the liquidity cushion to them. While DSRA provides short-term liquidity cushion, presence of force majeure clause (FM) safeguard the interest of investors and developers. But is the relief under FM real? As per the terms of concession agreement, SPV is eligible for claiming loss of toll revenue under non-political force majeure clause of concession agreement, wherein it is eligible to receive the extension of concession period. While toll suspension covers under the political force majeure clause, wherein SPV is eligible for monetary compensation in the form of reimbursement of O&M cost and interest payment. However, as per industry sources, monetary compensation is not expected for toll collection. Hence, SPVs in both the cases have to rely on extension of concession period as well as revenue shortfall loan. Over and above this, what we have seen in the past, that in some of the states like Gujarat and Maharashtra have announced the toll collect exemption on car. and subsequently there has been a delay in finalization of modalities for releasing compensation as well as delay in the release of compensation. This has impacted the cash flow of those operational SPVs. Hence, inefficient and tardy implementation of contractual force majeure clause shake investor appetite and increases dispute between the developer and authority. Now, finally, if we look at the impact of COVID-19 on 40 operational toll road projects, so what we can see from the slide is that 23% of the projects where there is either change in rating outlook or there is a rating downgrade has happened from a month of March to May, considering the decline in toll collection as well as the COVID-19 impact. So while 73% of the rated portfolio continued to remain at a stable, so those projects have shown a superior resilience even in the COVID-19 pandemic. Now, if we go further into this 18% of the projects, so what we can see is that in case of AAA projects or in the projects rated in the AA category, no rating downgrades have been there in the last 3 months despite COVID-19 impact. So this is mainly because of the long track record of operations of such projects, healthy toll collection, significant availability of the DESRA, and strong debt coverage indicators, while some of the projects are also being the part of InvIT, which carries a low leverage. While the majority of the downgrade has happened in the BBB category, we can see 70% rating downgrades have happened in the BBB category because of the inadequate DESRA mechanism in place in current scenario, and some downgrades have happened in the A category because of the declining toll collection and impact of change in Excel norms. Now we shall share our perspective on HAM projects. So based on the rating of the HAM projects and experience, what we have inferred is that strong sponsor with the good execution capability are able to execute the projects on time. 13 HAM projects with a debt of around 6,000 crores have already achieved the COD or applied. NHAI has also timely released construction annuity along with the inflation indexation. That is a positive. But on the contrary, if we see the journey of HAM for last 1 year, so there are more cracks than repairs marked by the execution delay. Apart from moderation in the credit profile, lower availability of a continuous ROW, and the delay in the descoping of available land, that delay in the descoping of unavailable land, those are the major challenges faced by the industry. Reneging of the contractual terms in terms of the descoping of unavailable land is a concern from the industry and has significantly impacted the investor as well as the bidder appetite for the HAM projects. Further, process of receiving extension of time EOT is also lengthy, even in case of the delays attributed to the authority or in force majeure, which results into commencement of the debt repayment prior to the COD. So after explaining our perspective on HAM in construction phase, now we will look at the emerging risk in the operational HAM projects, which has been discussed earlier, that the bank rate has declined significantly from 6.75% to 4.25%. So over the period of time, bank rate has declined by 250 basis points, while the lending rate has declined only by 100 basis points. Hence, non-linear transmission of bank rate over MCLR and variable nature of annuity are expected to dampen the stake sale prospects of operational HAM projects and moderate the debt coverage indicators, especially for the aggressively bid projects, which we cover in the next slide. So for analyzing the same, what we have done is that we have developed two scenarios. So in the first scenario, developer has not assumed any inflation indexation in the cost of project. So the project cost is structured at bid project cost or even less than that. So since in this case, what we can see is that even though bank rate has declined from 6.75 to 4.25%, but what we can infer is that the DSCR is expected to remain at a comfortable level at 1.21 times, because developers are eligible to receive the annuities at a higher completion cost, and they have structured the project cost at a lower level. They have some cushion. While in the second case, in case the developer have structured the project cost at higher than bid project cost. So they have relatively high debt level, which is expected to moderate the debt coverage indicators in light of this falling bank rate. So in nutshell, the projects where the project cost is a greater than bid project cost, we believe that there is a relatively higher cash flow resilience. Projects where the project cost is greater than bid project cost, the cash flow cushion is expected to be moderate. And further, if there is an aggressive bidding and it falls under scenario 2, where the project cost is greater than bid project cost, so cash flow resilience is expected to remain low. So the key takeaways of this presentation is that both project execution as well as award are expected to remain decline significantly in FY21. Freight dominated traffic is expected to bounce back faster. Higher cash flow resilience observed for mature toll road projects with liquidity buffer and low leverage even during COVID-19 pandemic. Structural issues in HAM, fall in bank rate and COVID-19 together have resulted into the dismal investor sentiment for stake sale, InvIT and TOT. However, the good part is that the sponsor with good execution capability are the beneficiary under HAM. So what should be done by authority, developer and a lender to bring the BOT back on track? So if we look at that, so from authority side, on-time approval for descoping and extension of time are perquisite, and prompt disbursal of arbitration claim and force majeure compensation is crucial for improving investor sentiment in the BOT projects. From developer side, timely completion of the HAM projects and sensible bidding is crucial. From lender side, there is a refinancing opportunity available, especially for completed HAM projects which have a higher cash flow resilience as discussed earlier. And most important is the improvement in the credit appetite for the lender is crucial to bring BOT back on track. Thank you. Now I hand over the session to Mr. Amod Khanorkar for further proceeding.
Thank you, Maulesh. That's a, I must say, pretty detailed presentation. You know, because of so many issues and questions and thoughts hovering on the on some of these challenging issues, you know, we felt it appropriate to hold this webinar and get some answers from the experts. These issues are important to us from a rating agency perspective. We have to continuously assess the credit risk. Complexity of analysis has only increased over a period of time. The intensity of surveillance thereby, you know, in turn, how we are responding. Our surveillances and the intensity of that, the analytical rigor of that has significantly increased. I would not like to, you know, impose myself any further, and I'd like to move on to the panel discussion. Before I start, I would like to inform all the participants they are currently in a listen-only mode. If you have any question, you may raise hand in the panel on left of your screen or type in your question in the window provided. I'll start the discussion with the panelists now. My first question is to Mr. Subramanian. In the presentation, we have seen that Care Ratings expectation of a toll deflation by 20% in FY21 owing to impact of COVID-19 pandemic. Stretches with traffic dominated by passenger car are expected to see slow ramp up as compared to commercial vehicle traffic post the lockdown. You know, we have also seen factors like change in axle norm, which Maulesh just mentioned, thereby reduction in overloading income and acting as a permanent dampener for toll collection. Considering all this, Mr. Subramanian, what is your expectation on toll growth in FY21 as well as over medium term? What are the factors you think can lead to a sharp recovery in some of these?
Thank you, Ron, and thank you everyone for giving me an opportunity to participate in this discussion. So very clearly, FY21 is a dampening year for us, and we would not have liked to have it. Having said, when we commenced tolling on the 20th of April, we started off with about 25% around that number across portfolio of assets. We today have about 6 assets which we recently acquired and 5 earlier. So about 11 assets. When we started looking at it, we found that we were 25%, but gradually we reached a peak level of 65% sometime back. Naturally, it was very glad to note that you reached that kind of a number within a month. Having said, we also knew that that could be because of pent-up demand, and also the fact that all of a sudden when the lockdown was imposed, a huge amount of trucks would have been stranded and the inventory would have been there to be collected. So having said that, we realized that there could be some kind of reduction which would happen, which we are also seeing. One strange case all of us know, the exodus or the migration of the labor force. One of the projects, Dhule Palestine in particular, witnessed about 93% of the budgeted number which we had. We really knew that this was not something which was because of the economy showing signs of revival so quickly, but it was because of the labor which was moving, and we knew that that would also be coming down. So having said, we are doing about at 60% at this point in time at the overall portfolio level. There are corridors which are doing well. There are corridors which are not doing that well. Car corridors you did mention. I do agree that it will be quite some time before people start moving for leisurely travel or a tourism-related commercial traffic would continue to show a ramp up over a period of time. So our expectation is, considering April and May, we know the numbers at this point in time, and slowly there will be a ramp up over a period of time. Maybe by October, November or so, you could ramp up to 80 or 85%. So what you have articulated about 20% drop in the overall revenue is something which is imminent. One other important facet which you need to understand is another surge of this infection spreading, and if there is a lockdown which might happen sometime later, then that definitely will have one more impact. But having said, we would expect the ramp up over a 6-month period starting from April, and then maybe reach around 80-85% from October, and then wait for the normalcy to be restored over a period of time. What are the requirements in terms of how the sector would grow in FY21, or what are the requirements? Manufacturing has to start, but naturally with the kind of protocols which we have, safety protocols, social distancing norms, and also the fact that you cannot have the entire labor force out there. So naturally, manufacturing would be picking up slowly. Similarly, many of those estates, essential ones like real estate and all, cannot see that uptake because the labor is already migrated, and for them to come back would be a challenge. Having migrated in an exodus, the return would be slow. So to that extent, naturally the real estate and has to pick up. So cement and steel are some of the big commodities which make the move on the corridors. And if you don't have those things picking up, then that's going to be a challenge. So I think the labor force has to come back. There has to be efforts for that. The packages which have been announced by the government will also act as a push. But having said, FY21, if we are able to do with this kind of ramp up and reach about 80%, is what I would say. But beyond that, we need to wait. Some positive things which have happened is the ETC has been a very good initiative. The government pushed it last year, and people are sort of skeptical whether it will all happen, or for that matter, whether we will be in a position to do so. Happy to see that the ETC penetration is so good that almost all the projects are doing 60 plus, and some of the projects in our portfolio are doing 80%. That is really acting as a good issue for us, because today cash collection, if it comes down, and to the extent that ETC is working, that reduces the total interaction between the toll collector and the drivers, and that also helps us in ensuring the safety protocols of that. So those are all things which are positives. The alternate routes, Mr. Mahajan did mention about the alternate routes. I have a strong feeling that once these FASTag has been introduced, people would tend to avoid those, because cash was something which incentivized possibly the drivers and all to save on. But once the FASTag penetration is more, possibly people would go through the normal routes as opposed to the alternate routes. And having said that, to that extent, the trunk routes or the routes where we are invested should definitely go. So this is where I would say. One more point in terms of the investors, we have marquee investors with us, so they're also looking at it very positively. I'll stop here.
Great, thanks a lot. So something like 80-85% in FY21 itself. So that will be really heartening. If we go to that number. Thanks for your inputs, Mr. Subramanian. My next question is to Mr. Mopalwar. During last 5 years, twice we witnessed toll suspension for around 1 month due to force majeure events. One was demonetization and second was COVID. This time around, that is a COVID-related issue. The toll collection recovery is expected to be prolonged considering the intensity of outbreak. Mr. Subramanian just mentioned that about 85% we will possibly reach. Now the point is there are clauses in the concession agreement to compensate the developers in such events. According to you, Mr. Mopalwar, as a regulatory authority, what should be done to address the issue of inadequate FM relief and resurrect the investor confidence in a PPP model? Over to you.
Yeah, thank you very much. First of all, the presentation from CARE was excellent. Now, when we're looking at the question that you sent me earlier, in fact, those questions are right before me. What is to be done about the inadequacy of the FM relief and the toll stoppage in Maharashtra? In fact, I am better equipped to tell you something about the toll stoppage in the state of Maharashtra and Gujarat, because the FM relief is one issue which is taken by Ministry of Finance and Ministry of Road Transport and Highways, and they have issued an OM, office memorandum, delineating as to what kind of relief will be there in two parts. One was between 25th of March to 20th of April, and beyond 20th of April. So, what state governments would normally do, they will go by what Government of India has already instructed, or what were the guidelines they have laid down in that OM regarding the FM relief for COVID. Now, it's a fact that in 2016, when we had the demonetization in November, it was 52 days, and again this time we have massive disruption of the toll collection. But the issue of toll is not only an administrative and contractual issue; it's basically a issue of the political economy. When you look at why toll was suspended in Maharashtra, now we have Mr. Vinod Agarwal from the industry here. L&T also is a major player in the industry. See, toll for almost 7-8 years, between 2006 and 2014, attracted a lot of adverse publicity because of, there used to be clause in the toll agreement or the concession agreement where you say you start tolling after 25% of the work is completed. Now, when you complete 25% work, it is certified. People are not happy about it. Maybe that model concession agreement or the concession agreement which was developed in late 90s, we didn't have great prior experience, and we suffered of that. And the kind of education that built up amongst the public that this 25% is not 25%, it is not even 10%, all kinds of objections were there. So we need to understand tolling is not a contractual, only a contractual job or administrative job or engineer's job. It's much of a political economy or socio-political economy, I must say. That's how the agitations came, and then in 2015, Gujarat as well as Maharashtra, we went ahead and exempted car traffic from the toll collection. Now, that was the precise point of time that I joined as the MD of MSRDC, and this issue was discussed at length. And what we realized, the total toll collection, when we actually apportion it, it is between 70 and 80% that it's a goods traffic, and between 20 and 30% it's a car traffic, the total value of the toll collection. Then the government of Maharashtra took a very conscious view. Now, one of the points which was made, and it was validly made, that we actually exempted the cars and buses, but we did not actually take a decision on the modalities to compensate the contractors. Yes, on 15th of May 2015, we issued the GO or GR, what we call, and it was almost January, February of 2017, 1 year and 8 months that we took time to come to a conclusion as to how compensation is paid. But after that, compensation is being paid according to the formula which was arrived at almost by consensus at that point of time. Now I do not foresee any possibility of further toll suspensions as far as because Maharashtra government has taken a view that on state roads, that should be exempted. So whatever now you have the project cost and the recovery cost, in fact, whatever the payback period, when we go for BOT projects or any other projects, now we have not taken up any new BOT project after 2015 in Maharashtra. On the contrary, we have gone ahead with almost 10,000 kilometers HAM projects. So any new BOT projects, the way we are looking at, we are taking that the MSRDC is the entrepreneur. We take it from government gives us a concession, and then we go for EPC and construct it, and then we have a payback period, which is agreed to go by government of Maharashtra, so that risk is not actually shifted to the investor or entrepreneur. So all our projects, we have 3 major projects. As of today, we are executing projects for 75,000 crores, and all these are EPC projects. And back to back, we are the concessions from government of Maharashtra, where we will be collecting toll and paying back the debt rates. So actually, in this respect, I am more with Vinod Agarwal than with the government or as a regulator at that point of time. You know, we are in the same boat when it comes to it, and when it comes to administering a contract, you have made 2 specific points. One is FM compensations. FM compensations, I personally feel, and I'm going to make that point, that we should not really interpret or reinterpret all these things. Everything is properly provided in the contract. There can be model concession agreement. So whatever goes or whatever is provided, that should be done. No further interpretation, because these interpretations give a lot of discretion. And the moment there is discretion, and then what is your loss? Okay, we'll try to help you out by giving some loan at low percent. All those kinds of discussions take place. You have specifically political force major and non. Once you classify that, then further, I do not think we should. The regulator should tell this is the way that you should calculate. How it should be calculated is part of the concession agreement. Further explanations, further discussions on that. That is that, in fact, wherever there is a deliberation or there is the discretion or authority invested with a lot of discretion, then this should happen. So we will be also, along with the industry, discussing with Government of India as well as NHI as to how this FM issue should be addressed. I think now we have a lot of HAM projects in Maharashtra. We are not foreseeing any problem because they are almost like EPC, where the only difference is that here we are paying them over a period of 10 years or 15 years every 6 months, and we are not foreseeing any problem. I think I have made my point on the FM as well as on the toll suspension. But one thing, the perception amongst people about the toll road, please, we must note that industry also is equally responsible. Each of us have to pull up ourselves. Industry has to pull up itself, the regulators have to pull up itself, because finally, projects and the contract that they are there, but the individuals matter. How we conduct ourselves in industry, how we conduct ourselves as a regulatory authority, and how the political economic players conduct themselves, that also has an impact when finally projects are delivered. Thank you.
Thank you, Mr. Mopalwar. So a lot of points and important points you made in terms of toll stoppage. That's not only a admin or a contractual issue, it's a political, socio-political issue. Maharashtra government increasingly moving towards EPC. All players, all stakeholders have to take care and pull up the socks to make the whole story work. Very interesting. Shiva, my next question is to you. In fact, 2 questions. Quickly, what is your long-term outlook for the toll road projects in terms of funding for them? And secondly, the uncertainty in toll road and delay in receipt of support from authority, that necessitates liquidity backup at the SPV level. So what are the new evolving risk mitigation features that you foresee in project finance? These are 2 questions I thought, I'll pick up your brains on, please.
The fundamentals of project finance have always remained the same. Any project which is well structured, when I say well structured, I'm saying a project with a diversified traffic, conservative revenue estimates from the point of view of a lender, cash which is set aside for major maintenance as also for debt service reserve, liquidity buffers, sufficiently long tenors, reasonably high percentage in BOT, toll and BOT annuity, reasonably high percentage of fixed interest rate. I'm not referring to HAM, I'm referring to the other 2 modules, and a sufficient DSCR cushion. If these 7 points are there, any project will be able to withstand difficulties which come, temporary mismatches of cash flows which will come. We have financed projects based on these 7 principles as any prudent lender would. We did not find any issues during demonetization. The current situation also, we estimate that most projects would go back to pre-lockdown levels sometime during the 3rd quarter and some of them in the 4th quarter, depending on the breakup of their traffic and the kind of routes that they have taken. Now, in terms of the point that you mentioned, the requirement for liquidity, actually we have always insisted on a requirement of at least 6 months debt service reserve accounts to cover 6 months of debt service. We have always insisted on that in all our projects. We have never found a situation where we have been faced with default-like or close to default-like situations. We have been okay, and most prudent lenders should be okay with letting go of any projects that do not adhere to standards. Liquidity buffer is really the only solution to cases where there are unpredictable mismatches of cash flows, including the current situation. Does that give you a feel of thinking of lenders?
Certainly. So, well-structured projects, fundamentals of project finance, they continue to be same. Long tenors, no ALM issues, fixed interest, DSCR question, ALM mismatches to be taken care of. Some of these are the pearls of wisdom which have been always. And to be very frank, some of the when things like this are taken care of, we have also seen that we have not seen defaults happening in our rated universe over last so many years. Some of the well-structured projects, they have withstood all the challenges that have come up over a period of time. So thanks a lot for that, Shiva. Moving on, my next question is to Mr. Agarwal, Vinod Agarwal. It is fair that the effective resolution of contractual dispute and release of arbitration claim is the need of the hour. NHA has formed a reconciliation committee for early resolution of the same and quick release of funds. Now, what I would like to understand from you is your experience on this front as a developer, and what can be and what all should be done for effective resolution of disputes. This is something that, from a horse's mouth, so to say, is what I would like to understand. Yeah.
थैंक यू सर. सर थोड़ा मुझे ये कहना इसके लिए जो मेरी समझ है कि जो डिस्प्यूट है थोड़ा हम जो गवर्नमेंट लेवल पे जो अथॉरिटीज हैं जैसे राधेश्याम साहब बैठे हैं, तो क्या है कि सब जो डिस्प्यूट इनके क्यों होते हैं उसके कारण में जब तक आप नहीं जाएंगे कोई रिजोल्यूशन नहीं होगा. अभी जो हम लोग जो फेस कर रहे हैं सबसे बड़ी जो प्रॉब्लम है, जो कॉन्ट्रैक्ट एग्रीमेंट है उसको नीचे के लोग ऑनर नहीं करते हैं, उसके कारण मैक्सिमम डिस्प्यूट होते हैं. अगर ये कॉन्ट्रैक्ट अपने जो कॉन्ट्रैक्ट इतने क्लियर हैं उसके अंदर ये लिखा हुआ है कि आप 180 दिन के बाद अगर जो आप लैंड नहीं दे पा रहे हैं उसको डिस्कप करेंगे, आपको सीओ मिल जाएंगे, लेकिन उन कॉन्ट्रैक्ट के जो क्लोजेज है उनको ऑनर नहीं किया जाता है. तो अभी जो रिकॉन्सिलेशन जो कमेटी बनी है उसमें भी हम लोगों ने यही कहा है सब हम लोग कुछ ऐसा करें मिलके, क्योंकि आज हम लोग जो काम कर रहे हैं आज सोसाइटी के लिए काम कर रहे हैं, गवर्नमेंट हम लोग ही हैं, कोई दूसरा नहीं है, कोई सामने पार्टी नहीं है, तो कम से कम डिस्प्यूट जितने कम हो उन चीजों पे हम लोग काम करें. तो जब तक कॉन्ट्रैक्ट के उसका आदर नहीं किया जाएगा डिस्प्यूट कम नहीं होंगे. अभी जो नए चेयरमैन आए हैं उन्होंने डिस्प्यूट कम करने की काफी कोशिश की है, रिकॉन्सिलेशन कमेटी बनाई है, उसमें भी हमने जो इशू उठाया है कि रिकॉन्सिलेशन जो कमेटी बना रहे हैं ये लोग, उसमें जो 3 मेंबर ले रहे हैं, तो उसमें भी उन्होंने ये कहा कि जो कंसेशनर की तरफ से जो मेंबर होगा वो भी उनके पैनल से लेना होगा. तो हम लोग कह रहे हैं कि जो हमारे जो मेंबर है हाँ, सेकंड और थर्ड नंबर का एक सेकंड अथॉरिटी की तरफ से होगा, तीसरा दोनों की म्यूचुअल अंडरस्टैंडिंग के साथ होगा. तो जो हमें मेंबर लेना है उसकी लिबर्टी हमें होनी चाहिए. तीसरी चीज जो क्लेम्स हैं, जो भी अवार्ड हैं, उसमें बैंक गारंटी के प्रोविजन है। तो ये सब नहीं होना चाहिए। सब क्लेम के अगेंस्ट बैंक गारंटी नहीं मिलती है। आज हम लोग जब काम कर रहे हैं अथॉरिटी के साथ, इतने सारे कॉन्ट्रैक्ट है, तो एक बार जब अवार्ड हो गया उसको एक कॉन्ट्रैक्टर की या कंसेशनर की अंडरटेकिंग लेके उसको पेमेंट रिलीज कर देना चाहिए कि आगे अगर अपील में वो हारता है तो वो विद इंटरेस्ट वापस जमा कराएगा। उसमें बैंक गारंटी की कंडीशन नहीं होनी चाहिए, क्योंकि आज जैसे हम लोग कई सारे अवार्ड हमारे फेयर में जारी हो चुके हैं, लेकिन आज उसमें कोई भी बैंक गारंटी देने के लिए तैयार नहीं, उसके लिए 100% एडवांस मांगते हैं। तो कम से कम अथॉरिटी को ये, एक अथॉरिटी की जो भी डिपार्टमेंट है उनको ये सुविधा देनी चाहिए कि एक बार अवार्ड जारी हो गया है तो उसको कॉन्ट्रैक्टर का अंडरटेकिंग लेके और उसको पेमेंट को रिलीज करो उसको, तो ही आगे ये काम हो पाएंगे।
ठीक है, आपके जवाब के लिए काफी धन्यवाद। काफी सारे इम्पोर्टेंट मुद्दों पे आपने डिस्कस किया। कॉन्ट्रैक्ट जो नीचे के लेवल पे है, ऑफिसर सभी रिस्पेक्ट करे। डिस्प्यूट इटसेल्फ कम निकले तो अच्छा है। डीजी की कंडीशंस पे कोई ज्यादा जोर ना दिया है। जो भी कॉन्ट्रैक्ट एंटर किया हुआ है उसे ऑनर करना चाहिए प्रिंसिपल में। So, some of these things are extremely important, and I think coming from you, I think, I hope everyone sort of picks up on this. Thanks a lot, Mr. Agarwal. Ajay, my next question is to you. Financing of, road sector, especially during the execution phase, it still relies on bank funding. And I know this is very close to your heart. I mean, you are a capital markets person, and so for us to, the banks, they still are facing credit crisis. They have their own challenges in terms of ability to fund. They are also required to fund, if they fund during the risky and critical phase of the project lifespan. So how do we expand this the basket of financiers? You bring in more NBFC, more debt funds, more capital market participants. If you can throw some light on your perspective, please.
Yeah, sure, Amod. There are some very vibrant NBFCs and funds on the panel, so maybe you can also address this question to them. I'll just make some very high-level observations. At the end of the day, financiers are going to be comforted very well if the projects indeed brought out all those 7 things that Mr. Shiva Rajaraman talked about. The problem happens when there is a dispute, when on the ground challenges happen. Maybe they happen by exception. Maybe that as a past lender we saw some of this, so that could be by exception, not as a rule. I would leave that to the esteemed panelists to comment on. But the issues are that unless the roles and responsibilities on the PPP framework are very clearly understood, and those that underwrite the risks of land acquisition, those that underwrite the risk of let's say force majeure coming in, that if for 50 days or 60 days tolls are not getting collected, then there is a commitment to pay. Then are those payments coming on time? Are the disputes getting resolved on time? Or is there a constant procrastination? And there are dispute resolution mechanism goes through detailed sort of arbitration at times, and sometimes through the litigation process, and then lower courts, and then developers are knocking at the doors of higher courts, and in the process the excess working capital consumed or excess borrowing consumed continues to compound the interest rate and funding costs of the projects. So at the end of the day, lenders will be very happy to do good lending business. The challenges come when these projects are, let's say, funded 70-30. So frankly, the equity absorption cushion is only that much. At the end of the day, if DSCRs of 1.1, 1.2 start getting pushed towards 1 and perhaps even lower due to some of these factors where tolls are not getting collected on the road because there are sort of unstated exemptions to a lot of local villagers. Like I mentioned, I have come across some of these projects in my past where you go to NHAI will say, "Go, this is a state matter. The highways in the state talk to the state would say, look, you and I don't even have a contract, so we are not going to be able to honor these payments to you. So at the end of the day, year after year, you have lots of toll, uncollected toll that doesn't accrue to the project, and ultimately the lenders lose confidence in financing 15-year, 20-year risks, where you don't know that when the governments change, what will be the new government stance towards some of these projects. We have to honor contracts. We have to have respect for contracts. A contract once signed is a contract signed in blood till maturity. Now, where will we get this level of commitment to a signed contract? That is most important. Now, if the governments change, they start renegotiating PPAs, for instance, in the power sector, right? And we know you all know what I'm talking about. And then there are payments not made for not 1 month or 3 months, but for 8 months, 10 months, 12 months. How are the projects likely to remain current with the banking system? And the banking system makes 1%, 2% net interest margin. How are they supposed to take a 15% hit in the first year and going up to 25 in the second year, going up to 40% in the third year, and a complete write down at the end of fourth year? It's impossible for the banking system to fork out that type of money when the margins are 1 to 2% on against their funding costs, maybe 3%. That's about it. So the point I'm making, therefore, is that the onus lies on all the three players of the PPP: the concessionaire, which is the regulator in a way, the concessionee or the private sponsor, and the lenders, to make sure that the contracts are indeed viable and everybody plays their role to maturity of the contract. If you don't play those roles to the maturity of the contract, leakages happen. When leakages happen, uncertainty creeps in. The moment uncertainty creeps in, the lender says, look, man, I'm better off stepping away from this 15-year risk. I might as well finance working capital of an operating company for the next 1 year, make 50 basis point less margin, but I'll be happier that way. I won't have an NPA. That's the real issue. And I would request Amod, if others can comment on this, but this is my high-level comment to your question.
Absolutely, Ajay. I think project finance. I mean, the whole heart is in those bankable documents. If you don't respect that, there is no other recourse. There is no other way by which a lender can be serviced. It's only that particular asset. If that's not taken care of, we have a problem on hand. And I think you hit the nail there. I'm sorry. I think I need to make an announcement. I think Mr. Mopalwar wants to. He needs to leave. He's been called by CM. So thanks a lot to Mr. Mopalwar for being here with us. Thanks a lot, Mr. Mopalwar. You need to leave, right? That's what I we can't hear you.
We can't hear you, Mr. Mopalwar, but thank you very much for being a part of this. And we really appreciate your taking out the time and making all the very, very important comments. Thank you.
Thanks a lot. Thank you. Mr. Agarwal, मेरा अगला सवाल आपसे है.
जी हाँ सर.
Project. Yeah. So HAM projects में जो प्राइवेट कॉन्ट्रैक्टर का वो ये मेरा आदमी उनका आदमी ऐसा स्कोपिंग में और डीलिंकिंग ऑफ अनअवेलेबल लैंड, ये जो इशू आ रही है हैम प्रोजेक्ट्स में, इस कारण से इसका आकर्षण कम हो जाता है हैम प्रोजेक्ट का. तो एज ए डेवलपर आपका रवैया इसमें क्या है, आपका नजरिया इसमें क्या है, आपको क्या लगता है कि ये इसको एड्रेस करने के लिए क्या किया जा सकता है? अगर आप इस पे थोड़ा हमें मार्गदर्शन करें तो भी नाइस.
बिल्कुल. देखिए इसमें हैम प्रोजेक्ट्स में एक बार जब हम लोग एग्रीमेंट के अपॉइंटेड डेट ले लेते हैं, तो हम लोग हर कंसेशनर की, हमारी भी सबकी कोशिश ये रहनी चाहिए कि प्रोजेक्ट पूरा हो किसी भी तरह से. जब एग्रीमेंट करके हम काम शुरू कर देते हैं तो हम लोग भी पूरी कोशिश करते हैं कि जो भी बैलेंस लैंड है उसमें हम लोग पूरी कोशिश, हमारी टीम भी लगाते हैं साथ में, कि वो उसका एक्विजिशन टाइमली हो जाए. और हर कंसेशनर के लिए भी ये अच्छा है कि वो प्रोजेक्ट 100% कंप्लीट हो, लेकिन फिर भी कुछ कारणों से 10 से 15% लैंड आपको कंप्लीशन डेट तक भी नहीं हो पाती है. अभी रिसेंट हमने 2 हैम प्रोजेक्ट पूरे किए हैं. तो हमने फिर अथॉरिटी के साथ इस तरह का एग्रीमेंट किया है कि भी आप इसमें हमारे को कम सीओडी दे दीजिए, और जो बैलेंस लैंड है जब भी आप 1 साल के अंदर 6 महीने में जब भी आप देंगे और हम उनको रिमेनिंग काम पूरा कर देंगे। तो अथॉरिटी इसमें सपोर्ट कर रही है और उस मॉडल पे ये लोग सीओडी दे रहे हैं, तो ये ठीक भी है। अभी जैसे मैंने एक पंजाब में प्रोजेक्ट पूरा किया, उसमें एक स्ट्रक्चर में 300 मीटर लैंड नहीं मिला, तो मैं भी नहीं चाहूंगा उसको डिस्कोप हो, क्यों डिस्कोप होने से मेरा भी नाम खराब होता है कि वो स्ट्रक्चर जो है इनकम्प्लीट हमेशा पड़ा रहेगा, कौन दूसरी पार्टी आएगी कब पूरा करेगी। तो हमने उनको ये कहा जब भी आपकी ये लैंड डिस्प्यूट क्लियर हो जाएगा, जब अवेलेबल हो जाएगी तो हम उसको काम कर देंगे। तो अथॉरिटी को यही होना चाहिए। वैसे तो 180 दिन का है एग्रीमेंट के अंदर, 180 दिन के अंदर जितनी लैंड में उतना काम पूरा करने के बाद सीओडी देनी होती है, लेकिन हम लोग कोशिश करते हैं कि जब तक काम चल रहा है, जितनी भी लैंड मिली है उस पर 100% काम पूरा करके हम लोग सीओडी लेते हैं। तो अथॉरिटी इसमें भी सपोर्ट कर रही है, और डिस्कोप की बजाय वो एक एग्रीमेंट, सप्लीमेंट्री एग्रीमेंट वगैरह कर रहे हैं कि वो लैंड जब भी मिलेगी उस पर हम रिमेनिंग काम पूरा कर देंगे। तो ये मेरी समझ में दोनों के लिए ठीक है और अथॉरिटी इसमें सपोर्ट कर रही है।
बिल्कुल बिल्कुल, धन्यवाद। So, Mr. Subramanian, my quick question is to you. I mean, considering all these challenges, how do you look at ham? I mean, do you have appetite for ham anymore? Will you go ahead with that? What is your take on that?
First of all, the trust which you are representing, we don't take under construction projects. So ham has not been an area where we would be interested in. Having said that, it is only the operational phase projects, so which have completed 2 years of operations. We look at only those projects. And as a trust deed, it says, it sort of stops us from doing so. Having said, I think the question which you have raised this, the HAM projects are definitely going through this phase where the compensation which NHI gives and the bank rate which is now changed, that is going to hit the developers badly. And I think that is something which has to be addressed. Unless until NHI finds a way of compensating, it's going to be a big blow for these developers, because what they had planned, they're not going to get. Second, of course, to some extent, one can look at it, if the bank rates have fallen, at what point in time the banks would be in a position to refinance to some extent to mitigate that loss. Otherwise, it's going to be something like NHI would be the beneficiary in this entire game, and that will be almost looking at it as one-sided affair, wherein the developers have put in their hard-earned money, they have put in the resources, they have constructed those assets. But when it comes to the payment compensation from the other side, they're really getting treated discriminately. So I would believe that is really sad, because I don't think that's the right approach. There has to be relooked at it, because people have completed and are waiting for the annuities to come, and they find that that is not going to really compensate, because the lending rates will be higher and what they get is lower. Then the project is dead, the developer is dead. I don't think he'll be in a position to come out. So there has to be a relook at the contract in this case. And I would sense that, when we are talking of renegotiation of contracts, whether it was a deferment of revenue share, etc., I think these are all times when one has to really look at it and then renegotiate the contracts. And in each case, even if the so-called distressed seller or the HAM project owner is interested in coming to the market, anyone who's going to buy it is going to discount that and then take it, right? So to that extent, the developer who has developed the project has already suffered. So I think this is something which has to be done. It's a challenging situation. There are no other answers. So far as we are concerned, we're insulated because we don't look at HAM projects.
Okay, thanks a lot. In fact, we are pretty short on time, but I'll take one quick question to Shiva. Shiva, as a lender, how do you view the operational HAM projects against a conventional annuity for a structured financing, considering the variable nature of annuity and a steep fall in bank rate? How will you address the aggressive bidding for O&M annuity at the time of refi? If you can quickly give your thoughts on this, it will be nice.
Shiva,
Good points. The operational HAM projects obviously have the bank rate issue, which has been discussed. There are 3-4 solutions to that. One is, of course, to look at NHAI to provide a solution. But there are solutions that we can look at by ourselves also. We are examining the possibility of issue of bonds on our liabilities side, which will mirror a bank rate based product. In other words, our assets or projects on our asset side have the bank rate issue, can we solve this problem by issuing bonds on our liability side, which have similar interest rate characteristics, so that that risk is entirely passed on. We are finding some thing in the market, some demand in the market, though it may not be very high. The second point is we are working along with an international financier and a rating agency to try to develop a derivative product that takes care of this interest rate differential between the two at an affordable and a viable rate. So these two solutions, of course, will take some time. It may take 5 months, 6 months to come.
Very, very interesting. I think, the liability.
But if either of these solutions, people traditionally look at the asset side. Liabilities are also important to look at. The second point, very quickly, I would like to add also to the point that Mr. Ajay Mahajan had made. Actually, there are 13 to 14 different sources from which money can be obtained for infrastructure finance. As on date, in India, only 3 or 4 of these sources have been tapped. To give an example, sovereign funds, pension funds, insurers, foundations, family groups, private debt, endowments, wealth managers, asset managers, banks, NBFCs, multilaterals, there are quite a few. And here I'm talking about debt, not the equity part. So only 3 of these have been tapped in India. And the main one, which is bank financing, a lot of cases we find there is a lack of expertise. There are asset liability management issues. There are concentration limit issues, and a kind of name lending environment rather than non-recourse project finance, which is there. Now, these all have to change. If you see many banks, and I will not be naming any of them, many of them in their infrastructure portfolio have NPAs of 50 and 55%. And this is given in their own Basel filings. And many of these are very large banks in India. So 40, 50, 60% of NPAs clearly reflects a lack of expertise. Now that part also needs to be taken care, because without expertise, you will not have sustainable, viable project finance. Does that give you some kind of?
Yes, I think that's quite a handful, I must say. Liability mirroring bonds, which shows bonds on liability side, which again reflect your issues on NHAI, lack of expertise at the assessing officer level, some of those resulting to higher NPAs. Very true and very burning issues, I think, in the infrastructure space. Ajay, in fact, I have a lot of questions for you also, but I think for sake of time, if you permit me, I would like to move to a Q&A session. I think we have a lot of questions which have come up, and with your permission, I'll shift to a Q&A panel.
Sure, please go ahead.
Great, thanks. So, Maulesh, can we please start on a Q&A from the audience, please?
Yes, sir. So we have received a lot of questions from the audience. So many of the questions have also been asked by the eminent panelists. So we will exclude those questions. So we will take the questions which have not been asked to the panelists. So first, we'll request Mr. Parvez Qazi. We request Mr. Parvez Qazi to ask the question to the panelist. Mr. Parvez.
Yeah, hi sir. Thanks for giving me the opportunity to ask this question. The question that we ask is obviously because of COVID-19, there has been a significant hit to the government finances also. Considering that, what is the kind of project award that we see going ahead from the NHAI in, let's say, FY21 and 22? And what is likely to be the split between EPC and HAM projects in this kind of project award?
Should I give you my views? So one is, I think, what will be the, I'll give you my views about what can NHAI come out with, and then maybe others can also add. Definitely NHAI is trying with the idea of TOT as a model. Even the National Infrastructure Pipeline, which had come about, this was something which they had talked about, and having tasted success in the TOT model, that's something which we can possibly expect. More so because that helps NHAI in monetizing their assets, and the TOT projects also would have some interest on the so-called funds, the foreign funds which are there, including pension funds, sovereign funds, there would be definitely interest which would be there. So I believe NHA should concentrate or would concentrate on the TOT model to monetize their assets, and the release of capital from therein, that will also sort of fuel their EPC related funding requirements. So to that extent, that's the model I believe NHA would follow. And I didn't have the other question. First question I couldn't really hear out very clearly because voice was not clear. But this is what I would believe NHA would be focusing upon, and would be the area I think they should focus upon.
Sure, sir. Thanks.
So second question is from Ansal Chauhan. So Ansal, can you ask the question? Hello, Ansal, are you there? Okay, so we'll take another question.
Hello.
Yeah, Ansal, you can ask the question.
Yeah, I just wanted to actually ask the panelists part of my questions already been answered, but just reiterate that, when do you expect the toll collection to reach the pre-COVID levels?
Let me take that question being from the side operating about 11 assets. I would just give my views. As I had already mentioned, possibly we should be seeing a ramp up happening over a period of time. And this general consensus is by October, possibly we should reach the level which in this year we should see. We will not see 100% at all this year. That's a challenge. More so because manufacturing is yet to pick up 100%. The labor is not there. Migrant labor is gone. So real estate will not pick up. The cement and steel movement definitely or would be dampened. So, and the other globally also the economies have to pick up and the business has to be restored. So this year FY21 to see 100% reaching at any point in time could be a challenge. I would tend to say that it will be the first quarter of next year. Having said that, Q4 to see kind of a number as compared to maybe Q2 or Q3. And one more indicators which are coming out is that the second surge of this, even if you pick up sometime, let's say in October or so, maybe there could be a dampening months in the month of November, December, depending upon whether the infections spreads or not. So in that context is what I said, you may never be able to reach 100%. Possibly the first quarter of next year is what my guess is.
Okay. Thank you so much.
30% of projects that we have financed have reached around 80% of pre-lockdown levels. Another 30% have reached between 50 to 60% of pre-lockdown levels. And the balance 40% of projects are roughly in the 25 to 35 range. So on a weighted average basis, projects have reached, projects that we have financed have reached around 50 to 55% of pre-lockdown levels as of yesterday. What we expect is the projects which are more linked to local traffic or local supply will reach these levels much faster. Projects which are linked to construction will take 2 to 4 months. Projects which are linked to specific industries like automobile industry, etc., could take 3 to 5 months. And projects which are linked to, for example, temples or religion would start ramping up once the government permits the opening of temples, etc., because this is the segment which is generally the least in terms of, well, we refer to it as relatively inelastic.
So there is a question from Mr. Mukesh Agarwal. So Mr. Mukesh Agarwal, can you introduce yourself and then ask the question to the panelist?
Yeah, sure. Thanks for the opportunity. I'm part of ARCIL, ARC. So my question is, there are like two questions here. One is on the distressed. How do you see the private flow of private credit, the FPIs and the distressed asset funds? For lapping up some of these cases which are under stress and which are available for sale, by the banks via an OTS method, or under the IBC, under the CIRP process. So do you think there'll be enough credit flow, or the foreign funds, they'll be now more savvy and they'll step back, and probably the flow, the dry powder will be a little less visible, at least for the remainder of the year in FY21? That's one question. And the second question is on the arbitration awards. Do you think the entire process will get expedited, and it will instill some confidence, and all of us distressed funds, when we look at these assets, we can give some value to the claims, to the awards coming in, or will that continue? We'll have to continue to keep neglecting it, and only price the actual cash flows of the asset. So these are the two questions.
May I attempt to answer the first part of your question?
I'll take the second question on your.
I would request the panelists to join me to also help with their views. So on the distressed assets, my own view on this is that for a while we will probably see distressed assets take a backseat. Distressed asset funds take a backseat for various reasons. Post-COVID, you don't know. Firstly, there is always with stressed assets highest level of uncertainty with respect to cash flows. Just to fully understand, distressed assets work with a cost of capital of 20 to 25%, and they expect that type of return from their investments. Considering the lockdown, considering highest level of uncertainty with regard to unlocking of cash flows, even on standard assets, it becomes that much harder to predict cash flows coming from stressed assets. Firstly, secondly, the IBC. The admission of new assets has been postponed by a year. Also, in the IBC, only 5 or 6 large assets have actually gone through a resolution process, and one could argue all of those large assets were to do with high capex industries like steel and perhaps cement. So largely manufacturing oriented, large capex projects have seen some resolution, but we haven't really seen across the board resolution. IBC pipeline has only expanded substantially, and resolution has got deeply impacted. So I'm not sure if distressed funds will make a beeline to acquire more assets through the IBC framework. But I agree with you that if there is half a chance, it will probably come from an OTS type of resolution, because ultimately we all have to hope that the central bank will allow at some stage restructuring mechanisms to come back to the table, and moratorium after moratorium may not be the only solution for all client segments that borrow from the banking system. So if I were to hazard a guess, I would say more OTS than IBC for the next 12, 18 months, 24 months, firstly. Secondly, lower volume in absolute terms. Thirdly, with the entire world impacted by COVID, I don't think there will be a mad rush to acquire stressed assets when even some of the more viable projects are going to be quite stressed for cash flows. That's my sort of limited answer to one part of your question. I would request the panelists to add if they have a view.
Yeah, the SR case, SR case in the Supreme Court and the IBC which had come out earlier, both gave a lot of confidence to distressed asset funds if you're talking about foreign funds entering in India. Now, in both cases, now IBC, as Mr. Mahajan mentioned, there is a postponement. Second point is that for foreign funds, it is a little difficult for them to estimate their returns after assessment of the foreign exchange risk, because right now it is very difficult to estimate the foreign exchange risk. Right? So these 2 points alone, I believe, will make them wait and watch for some time before they enter. How long will that sometime be? Possibly 6 months. There can't be a definitive answer to this. The third point is that there are distressed funds that are more interested in projects which have physical assets on the ground. For example, a building, hotels, that kind of thing. There are not that many distressed asset funds internationally which focus on projects like road projects. So these three areas, in my personal view, will make them wait and watch for some time till the situation stabilizes before they step in.
So next question is from Nandita Iyer. So our next question is from Nandita Iyer. So Nandita, can you introduce yourself and ask a question?
From just wanted to understand, there are so many roads which are planned under the Bharatmala or other programs. So given this, many roads are likely to become a competing facility to each other. And today, given the concession agreement provisions, they are quite wide to capture this. So what protective measures should actually be there in the concession, and are you aware of any of those measures being contemplated at present?
Couldn't hear the question properly. If somebody could repeat.
Nandita, there was a lot of echo, so we couldn't hear you.
She has asked sir, I can read out. So her question is that given so many roads planned under the Bharatmala program or other program, many roads are likely to become competing each other. What protective measures need to be provided for that in the concession agreement, and are any measures being contemplated at present?
Maulesh, I think problem is at your end. You need to mute. There are 2-3 lines on
the lot of disturbance.
Yes, sir. Now, sir, I think it is over. So some issue was there at attendees. So, sir, I repeat the question. Her question is that given so many roads planned under the Bharatmala program or other programs, many roads are likely to become competing facility. What protective measure needs to be provided for that in the concession agreement, and any measures being contemplated at present?
So I guess, I think if there's Amod here, and if as a developer, if you are going to take up a road project, I mean, you will try to make sure that you don't have a feature that allows a competing road to come up, or if it or either now or in future. That is something that you will try to do. And if it comes, then first right of a refusal, offer, so to say, possibly should be with this particular developer who's going to develop the first road. Some of those mechanisms will have to be built in. Otherwise, it's going to be a challenge.
Right now, I'm not aware whether any of these mechanisms are being contemplated by the government. Right now, I'm not aware of any such mechanisms which are being contemplated by the government of India or NHAI. At least none have been announced so far. It is early days yet, but let me put it this way. I'm talking from the point of view of a lender, not that of a developer, but any lender who assesses a project will have to take into account some extent of leakage, despite contractual provisions which do not permit such leakages. This is because of the experience we have seen in the past, where alternative routes were not permitted as per the concession agreement, but there have been cases where state governments have allowed such routes. So any lender who gets into it, assuming that every part of the contract is going to be honored, given the past experience, it may not be a reasonable proposition. Therefore, you will need to build into your projections the possibility that there could be some leakages over a period of certain number of years. Given this point that Bharatmala would still take several years to get implemented and to have leakages of this nature, it can be predicted to some extent and provisioned in the financing, and long enough tenures need to be provided to take care of lower cash flows on account of this.
Yeah.
Yes, sir. So there is one question from Sheshanandan Ji from Mr. Subramanian. So the question is that what is your opinion on investing in toll roads and outer ring road?
Which outer ring road is being talked about?
Shall I repeat the question, sir?
Yeah, please. Can you repeat?
Yes, sir. Question is, sir, what is your view on investing in toll roads and outer ring roads?
Yeah, outer ring roads of cities, I suppose. That's what is the question. I am getting it that way. See, first of all, toll roads investment, I think we have all seen that depending upon the requirement, one has to really look at it. But toll roads definitely make a safe investment if it is a very generic question, if I understand it that way. We have already articulated that there are opportunities available for investors to invest in these roads, because these roads are definitely going to add cash flows. And as an investment vehicle, if you see, most of the foreign funds or pension funds from abroad have very heavily invested and are showing great interest in investing in Indian toll roads. So that is something which is very positive for India. If that is a question, if it's been asked. And there is another question on outer ring road. Am I right?
Yes, sir.
So when you talk of an outer ring road, is it a particular city you're talking of, or a generic question is it?
The general question. He has asked for the general question.
Fine. So when you're talking of an outer ring road of any, necessarily an outer ring road would be encompassing a city and would offer viable easy exist and also entry points to the city. Now, when you look at from that angle, almost all the outer ring roads will definitely have some traffic which would be commercial in nature. Am I audible?
Yes, sir.
Yes, please.
Okay. So definitely outer ring roads as a concept we have seen, we've also evaluated some in the past, and we do see that there are potentials. But the only thing is to predict the traffic in an outer ring road would always be a challenge, because it all depends upon which part of the outer ring road has more traffic and where does the entry point happen and where does the exit happens. So it is a challenge to sort of calculate or predict the traffic movement in outer ring road, especially if it has got certain entry and exit points which can emerge at any point in time. Secondly, it also depends on the infrastructure of the outer ring road, because if it gets choked at no time, then it gets into a problem mode also. The development of the city also contributes to that, because if you have seen outer ring roads and beyond the outer ring roads also roads develop, and to that extent the inner ring road which was the original outer ring road could be a challenge in terms of the traffic. So it is a good opportunity, but then you have to really evaluate and see and then take a call.
Thank you, sir. Next question is from Mr. Pawan Kumar. So
Mr. Pawan, can you go ahead and ask a question?
due to technical error.
Then
So
yeah. So Maulesh, then
This
should
was
we
the
close
last
then?
question,
I think
sir. That was the last question, sir.
yeah.
So I hand it over to you.
Okay, because we are frankly speaking completely out of time. I think we had a very interesting session today. My heartfelt thanks to Mr. Agarwal, Mr. Rajaraman, Mr. Subramanian, and Mr. Mahajan, Ajay Mahajan, to all the participants who took out time and spent this evening with us. We really are thankful to you and look forward to your participation in our future such events. Thanks a lot, and with this we will end our. Ajay, you want to make any last comment before I sort of close?
Oh, thank you, Amod. Yeah, so I will just want to thank our eminent panelists. Thank you, Mr. Subramanian. Thank you, Mr. Rajaraman. Thank you, Mr. Agarwal. It's delightful to meet you all again over this panel, and thank you for sparing so much time answering all the questions that came from the audiences. Thank you to the audience for being so engaged. And I hope that the insightful comments made by our panelists were of immense use to you as you evaluate these businesses. And we surely and thoroughly enjoyed this session. I would only suggest that there'll be more coming from the stable of care ratings. And so stay tuned in, stay engaged. Thank you so much again.
Thank you, sir. Thank you.
Thank you very much.